How do I make money from stocks? Stock Strategies to Create Wealth by Dr. Melissa Cohen. So there are basically two main strategies on how to create wealth investing in the stock market. The first one is basically the stock price increase, and there's also dividend payments. Now we're going to talk about both of these in just a few moments, and we're going to go into these individually so that you will understand what a stock is, how do I actually make money in the stock market, and how do I plan to create wealth by investing in the stock market. Okay, so let's begin by explaining what is a stock. So basically, a stock in a company is a part ownership of the company. What happens is the company, when they talk about an IPO, it's an initial public offering, and that's when the company is first listed on the stock market. So what happens is the company, they're growing, they're a newer company, maybe they've only been in business 5 or even 10 years, and they need more money. They need a cash inflow so that they can grow their business. They have a lot of projects that they can invest in to create value, but they don't have enough money right now because all the money coming in is then going to invest in future projects. So one way that a company can get money is to issue stock, issue equities. That you may also hear it called an equity as well. So what happens is that you as an individual, you give the company money in exchange for a share of stock. Obviously, you will find out that depending on the company can depend on how much the stock price is currently. You can also depends on how many shares of stock they have actually issued to the general public to buy. So one company may have issued 10 million shares of stock. Another one may have 2 million shares of stock out in the market. So all of these different things are going to actually affect the price of the stock and such. So I'm not going to go into detail on how an IPO is valued, but basically I just want to let you know that if you are actually investing in a stock or you're buying stock, you are actually giving the money to the company in exchange for a share of the company. So the companies are expected to use the money to grow the company, whether they're investing in maybe new businesses, maybe new processes and such. They have identified, hopefully correctly, ways to grow the business for the long term. But they need some cash to do so. And so the companies, and just basically how a company works, they need raw materials, or they take raw materials from a company or services and such, depending on what type of company it is, and they create value. They sell it to consumers for, a little bit more money than what the raw materials were, so that they actually have a finished good that they can sell to consumers, and they want to sell that at a higher price, so they actually make money from doing all of these exchanges and such. The company, basically, they've identified some future opportunities, but they need money to grow, and they need your money to grow. Obviously, companies have a mix of debt, so they'll take on either corporate loans or they'll issue bonds and things like that, and as well as equity, which is issuing stock to the public to get money as well. So remember that if you own a piece of stock, you are now called a stockholder, or you will also see a shareholder as well. You typically have annual voting rights, especially for all the companies on the New York Stock Exchange. And usually, if you ever get that information in the mail, it is, or via email as well, you usually choose the board of directors every year. They have a nice biography and profile of the people that they would like to have on the board. You also need to approve executive compensation plans, and there may be a few other issues that have arisen through the year and such that require stockholder approval. Now, I will also let you know that most stocks of a company are owned by large hedge fund owners, institutional investors, pension funds, things like that. So when you actually look at the individual person who actually owns stock, it's actually pretty small. So usually most of these companies, their stock are owned by I'm just roughly giving you an example here, roughly 80% of the stocks are owned by these institutional investors. So when you and I are actually voting, there may be a few instances where our vote actually matters, but definitely feel free to vote as well. Okay, so let's go ahead and talk about what are the stock strategies for wealth. So when you are going to invest in a stock, what do you hope to get out of it? As I mentioned before, the first one is you want the stock price to increase over a long period of time. And the second one is dividend payouts. Now I will talk about and explain in both of these in detail momentarily. Alright, so the first strategy is stock prices increase. So over time, we want to assume and hope that the stock price increases over time. So this strategy is going to work best if you plan to hold your stock for many years. So we're talking 10, 20, 30 years at this point, not just 1 or 2 years, because the stock market is cyclical. So if it goes up, it's going to go down at some point. So I don't think anyone has successfully timed the market. So if you find anyone claiming that they can do that, then I would actually be aware of that as well. So what you want to do is, as an investment standpoint, you're going to put your money into the stock. Ideally, you want to buy low and sell high. That's the whole point. But we want to look at it the long term. So if you are buying stocks when you're 20, 30, 40 years old and you're not going to retire until you're 60, 70, or 80, then you definitely have several decades to invest and hope that the stock price increases. So let's go ahead and look at an example here. So I pulled this from the Procter & Gamble company stock here, and they're I think a Fortune 500. They do the Tide laundry detergent and Gain and Oil of Olay and Palmolive and Pampers, and so a lot of household consumer good products that you may be familiar with. So if we want to look at what their stock price was, if you look at the very bottom of this graph on the lower left-hand corner, you'll see that the price on July the 2nd, 1981 was $2.33. So then if we're looking at roughly 40 years later, the stock price, you can see where it's gone up and down. It's gone up and dropped, and it's gone up and dropped and up and dropped and up. But overall, it is a green line. So if you look at this entire time period, you'll see that it's green. So that means it has actually gone up. So the stock price has gone up to $137.95 over 40 years. So obviously, depending on wherever you buy this, except for if you're in this little peak, you're going to make money if you can hold on to the stock. Just a couple other notes you need to know about stocks and such. So remember, if you're just a novice, you're just an investor, you're just starting in your investing journey and such, know that day trading and option trading is very risky, even for professionals who are successful, who know the ins and outs of the markets, they know the rules, they know everything. I personally don't do day trading, and I actually don't do option trading. I didn't investigate it, but I think option trading is so much like gambling, because you're hoping that the stock is going to go down or up in a very short period of time, and so that's hard to predict. You can make some assumptions based on environment factors and things like that, but you don't have all of the information, and you can't predict the future. So I will say just stay away from that. And another note, though, is investors or people should not be investing money in the stock that you need within 5 years, because the market goes up and down and it's cyclical. You want to kind of ride that wave out, so to speak. So right now the market is doing pretty well. It's at near the top of its points as it has ever been. So if you need to retire in 5 years, you might want to start thinking about taking some of that money out. Obviously, when I'm looking at my personal plan, I'm like, okay, well, if I retire at 65, but I'm planning to live to 80, that's still 15 years. So, at that point, I would look at what my situation is and such. But if I had money in the market that I didn't need, I would keep a portion, maybe 15, 20% in the market. And especially if I didn't need it and I knew that it would be passed along to my children. And obviously, I'm in my mid-40s, so I've got another 20 years here. So when I get to my mid-60s there, and if that's an option, a possibility, then I would keep a portion of that money in the stock market, pass it along to the kids, and then they could keep it in the market as well. All right, so here is also another very important point to know, that stocks do not always increase. All right, so there is risk in investing in stocks. There's risk in investing in the stock market generally. So here are some reasons why stocks, individual stocks and company stocks do not increase over time. So the company can simply become irrelevant. They can lose customer interest, and the company can just slowly lose sales. I'll give you some examples in just a moment here. One company can simply be merged or acquired by another company, and then that company's stock will disappear. A company has to, in order to be listed on the New York Stock Exchange, which basically means you're available on the New York Stock Exchange for people to buy and sell your stock, you have to have a certain amount of money. If you continue to decline over a certain period of time, the New York Stock Exchange can decide to unlist your stock. Another reason why stocks can decrease over time is basically they got out of business. They're bankrupt and ultimately close down for business. So let's talk about a couple examples. So Blockbuster, obviously, they're still in business. I think they closed their last standing retail store just within, I think in 2020 or 2021. So I think they had one store they were pulled out. So obviously that company didn't pivot and become, I think they're doing a little bit of streaming, but they're losing out to Netflix and such. So they're slowly dying, as I say. Another brand that I could think of is Singular Wireless. They were bought by AT&T Wireless as well. So, and also JCPenney. And because I was an owner of JCPenney stock, that's how I know this, and also Fitbit, is they got bought out. I was doing some research. They got bought out by another company, and then they, within a short time, just filed for bankruptcy and declared JCPenney unable to pay their bills, and ultimately the stock, which basically means me as a stockholder, I'm the last one on the list that gets money when a company goes into bankruptcy. So the stock is worthless. So they delist it, they take it off. My $1,000 initial investment in JCPenney is just simply gone. So I lost $1,000 by investing in JCPenney. But I'm going to give you a couple positive examples. I don't want everything to be doom and gloom here. Is Netflix, as opposed to Blockbuster, they did adapt and they changed from the mail-in DVDs to online subscriptions. We also know that Apple has continued to innovate and evolve over time as well, so they're a growing company. Amazon most recently announced that they are buying MGM Studios. So they're actually still making acquisitions in different parts of their business as well. So companies are going to continue to grow and such, and may need more cash to do so. All right, so let's move on to the second strategy, which is dividends. So let me kind of work through some of this information from a corporate standpoint and just tell you what a dividend is so you actually understand what this is. So if the company, it's any company that has stock and such, if they are successful in creating value from the investment, from the money that they have, then the company creates additional profits. All right, so with these additional profits, some companies, they may choose to pay and reward their stockholders for the use of their money, and they do this through dividends. So basically, a company sells, they use your money, $20 for a share, they're able to sell their products, they do really well, they have great profit margins, and now they have all this extra money sitting at the end of the year. So they can decide what they want to do with it, and there's a couple different strategies. They can reinvest it to grow into new projects. They can also decide, this one is to pay dividends and reward our stockholders for their money, for using their money. So when you do that, or when companies do that, when you're actually looking for this as a strategy, companies announce the record date for stockholders on record of that date. So typically what happens is companies pay dividends quarterly and such. Now there are a few companies that do pay monthly. So whenever the quarter happens to end, they need a couple of weeks to do all the accounting records and close out the books and such. So typically what happens then is the company announces, okay, as of May 1st, all the stockholders on record will receive a dividend, but it's not going to be paid out until like May 13th. I'm just giving you, maybe a week later, and maybe 3 days, and maybe 2 weeks. It gives them some time to get all of that information, all of the money and such, and all that information routed through the different accounts to TD Ameritrade, your Fidelity, maybe you have stock through your bank or financial advisor or your insurance company. There's lots of different ways. So it gives the company time to get a record of all that information of all the people, and then get the money transferred to those bank accounts and then paid out. So what can happen though is, I'm going to use this as an example, one of the strategies some people do, instead of holding on to the company for a long term, they basically sell the company on May 2nd because they're on record as May 1st, so they'll get the dividends, but then they'll go to May 2nd, they'll sell it, and then go buy another stock that's going to pay out dividends quickly. Instead of waiting another 3 months for the second payout of dividends, they'll just take that money, go find another company that may pay out the next month. Now that does take some work to find out all that information as well, and like who's paying out when and that sort of thing, to make it worth your while to do that. Okay, also know that dividends are stated as annual amount per share, but they're typically paid quarterly. So when you're looking at your stock information, and I've got an example up here, it's coming up on the next slide, and it'll say dividend yield amount. And so that is based on the year. So for the last year, they look at that information, that how much money was paid out, and then they calculate the total dividend yield. But remember, you're typically only paid quarterly, so then you have to divide it by 4 so that you know how much money you're going to receive every quarter. So here we go on the next bullet point there. Dividend yield is the dividends per share price. Oh, okay. So this is based on dividends paid out the previous year. So they look at what was paid out the last 12 months, and that's how they calculate a dividend yield. So it's going to be a percentage. So typically a good dividend paying stock is about 4 to 6%. Anything better than that is like super great. And then some stocks may actually be below that amount. Now one thing to note, if the share price goes up but the dividends don't go up, your percentage is going to go down. So instead of, you could buy a company and it has a 6% dividend, but let's just say it did really well during the pandemic. So the stock price went up because they simply sold more products. But the company hasn't changed how much money they're paying in the dividends. So it may be a company that started out at 6% dividend yield, maybe a year later it's only a 4% dividend yield. So that may not necessarily mean that's a bad company stock to have. But depending on what your strategy is, you just simply need to be aware of that. If you're simply staying with a 6% dividend yield, that's fine. But if you're not, then you may need to choose a different stock or determine if that's going to be a long-term stock where you're hoping that the price will increase as well as paying a dividend. All right, so here's something we can look at. So I pulled this information from Procter & Gamble once again. So we're looking at their dividend history. So here we go. We have ex-dividend date. We have our dividend yield. So it's only, this company stock is only paying 2.55%, which isn't really great. It's something, but it's not great. So their annual dividend payout for the last 12 months was $3.47.9, right? So, but then you would have to divide it by 4. So if we're looking at this table on the bottom, we have our effective date. So that's, April 22nd, 2021. They paid cash. The cash amount was 87 cents per share, and the declaration date. So, and then we have the record date. Okay, so the declaration date is the date that the stockholders and the the declaration date is the date that the company executives and the board of directors declared that they were going to pay these dividends. They have a declaration date because once they officially say they are paying dividends and they say how much then it's an accounting standpoint. Then it moves from let's say one pocket of change to a different pocket of change. So they have to have an official date so that they can move the money on their records or accounting records. Okay, so the other one is the record date, and that is stockholders as of April 23rd. And then the payment date. So then all of that money, your 87 cents, will be paid out on May 17th. So it takes them about 3 weeks here to process all of that information. Now, if we were looking at the dividend history, we got 1, 2, 3, 4, 5, 6. So that's a year and a half of dividends paid out. So we can see that on January 23rd, 2020, they paid 74.6 cents. So it went to 79 cents. They held that steady all year, and then this year it jumped up to 87 cents. My guess is their sales went up a lot, and the executives decided to go ahead and pay that amount because they think that they are going to, 87 is the new normal versus the 79. All right, so here are a couple more details. So currently, Procter & Gamble stock is paying a quarterly dividend of 79 cents per share, and the company has a dividend yield of almost 2.5%. So one thing to note, though, is that Procter & Gamble has increased its dividend 5 times on a year-over-year basis over the last 5 years. So they do keep increasing their annual payment. That's basically what it means for the 5 years. If you took, if you looked at everything by year, so 2020 to 2021, and then back down to 2019, 2018, 2017, 2016. So their total dividends for the year have increased 5 times for the last 5 years. So it has an average annual increase of 3.94%. Okay, so I don't want to throw too many numbers, but the importance of that is that this company has continued to pay more dividends each year for the last 5 years, and at a 4% average increase. So their dividends are increasing, they're continuing to pay dividends every year, and the stock price overall has increased as well. So this is a solid company to invest in. I do, just as a disclaimer, have Procter & Gamble stock. I think I bought it in it was one of the first stocks I bought, like in 1999, 2000, something like that. And I can't even tell you how much I paid for it because there were paper records then and such. So I don't even know if I have all that information at this point, but it is in a retirement account, so I don't have to really keep up with that. All right, so here's also something to know, and where I was kind of leading with that Procter & Gamble here, is when you're considering the dividend payout strategy, as always, you always have to do your research on everything because nothing is 100% absolute as far as the rules go. But one thing you do need to kind of consider here when you're going to invest in like dividend paying stocks, especially with the pandemic, because the global pandemic disrupted normal business activity. So companies had to stop paying dividends. I actually have Nokia stock, so they chose to stop paying dividends in 2020. Even though they had been paying it out for several years before that, they decided just based on the economy and such, they would stop paying dividends. I haven't done research to see if they're paying again, but we'll find out. So one thing to generally know from a corporate finance standpoint is corporate dividend strategy. Typically, companies prefer to pay a steady dividend over time, the same amount, at least the same amount. If they can only afford 5 cents or 80 cents, they're going to try to keep it stable over time, because what it shows to the market and everyone in the stock market, in the business world, and in the industry, that the executives are knowledgeable, they're running the company well, the company's financially profitable, they're doing a great job, right? So they're going to try to keep that stable. And they're going to keep that stable even if a company has less profits than the quarter or the year before. So a company may have lost money in 2020, or their profit, instead of having $10 million in profit, they had $1 million in profit, but they may decide to keep paying the same dividend amount because they want everybody to know they're doing well and such. All right, so I just want you to be aware of that as well. So when you are doing research, you do need to go and look at the corporation and see if they're actually making money from during the COVID year and such. Just so that you know that they are financially stable and that they're not just going to fall off the radar in a couple of years as well. All right, so here's just a few other little things, and I'm not going to go into too much detail here, but companies, they can choose to pay a one-time special dividend as well. So if they went crazy well and they did such a great job, they, instead of increasing it from 79 cents to 87 cents a share, they may say, okay, let's keep it at 79 cents, but let's do a special one-time payout. That way, we're not committing to the dividend increase over a period of time. So that can happen. And another thing is companies can choose to split their stock too. And this is actually considered a special form of dividend. So instead of paying out all of the extra profits into dividends, they can simply say, okay, wait a minute, our stock price is so high, why don't we just split it and keep our cash, right? And then the money gets reinvested in the company. So I'm not going to go into all that as well, but that is a highlight as well. Apple has split several times over the course of its history, and so that always benefits the investor as well. All right. So moving on here, we have an instance, there are companies, whether even Fortune 500, Fortune 100 companies, that do not pay dividends. They are considered growing companies. They don't pay dividends because they want to take the money that they earn and they want to invest it in the company. They have other projects that they want to invest in, or companies they want to buy for future growth. So they think they can create value. And they're doing their best by saying, let's hold on to this money that we earn and generate, and let's reinvest it. So some of these companies include Facebook. You have Alphabet Company, which is Google. And you also have Amazon. So if you have these companies, the stock prices have gone up pretty high, but you've not received any dividends. So if you are going to dividend-only paying strategy, then you may also be missing out on some of these tech stocks that have gone up over time. All right, so that one we've already talked about, that bullet point. All right, so why would you even consider dividend strategies? Well, besides the reasons I've already mentioned, we're going to talk about just a few more. Investors like dividends for several reasons. So it basically greatly improves your stock investing profit. So when you're looking long term, how did the stock do and how did my portfolio do, it's more likely to improve the payouts and such. It also decreases your overall portfolio risk, because even guaranteed a 2% return on a dividend, and you're, a side note, never guaranteed these dividends, but if you have a company like Procter & Gamble that's paid out stock dividends historically for decades and kept it steady, then that reduces your risk, because the likelihood of them paying out dividends in the future will be the same. Also carries tax advantages. So depend on how you have your dividends set up, or your companies, if you own them just as an individual investor, or if you own them in a retirement account, there may be some tax advantages with that. And other thing is, not every company offers a quarterly payout as well. So you do have to make sure how often they pay out, whether it's annually, quarterly, and a few monthly. All right, so I'm just going to briefly go over tax implications, but the general rule of thumb is always talk to your tax advisor, your accountant, your attorney, whoever helps you with that, because your individual case and situation may be different than anybody else's. But here are some things that you do need to generally know. If you buy stocks and they're bought or sold outside of a retirement account, so I'm walking in and say, hey, I want to buy Coca-Cola stock. I don't want it in my retirement account. I just want to be the sole owner here. Remember, when you sell it, you have to pay capital gain taxes. Hopefully not any losses on that. So you do have to be mindful of that. Also, when you have them on your own, you do have to, dividends are taxed. They're considered income, I believe. I've never had a large, I've gotten like $5, $10, $20 a year in dividends outside of my retirement account. So that's not adversely affected me by any means, but that may be something applicable to you. And also know that when stocks are sold inside a retirement account, investors do not pay your capital gains taxes or on the gains or the dividends. So the purpose for this is the government has set the tax laws and rules up so that they are encouraging long-term investing in companies. Companies need money. They want your money to grow. They want to encourage this long-term investing versus a short-term and day trading investing as well. So there's no taxes on it when it grows. All right. So kind of to wrap up here, we're kind of looking at, well, which decision do I want, which do I don't, or which strategy do I want? Do I want my stocks to grow, or do I want to rely on this maybe steady stream of income through these dividend paying stocks? Well, as I mentioned before, investors can choose to include a mix of both kinds of companies as well. So thank you for joining me. How do I make money from stocks? Some stock strategies to create wealth. Once again, this is Dr. Melissa Cohen. If you have any questions, feel free to reach out to me. And if you like this video and you like this presentation, please be sure to like it on YouTube and subscribe to our channel. Thank you very much. Have a great day.